let's also welcome in Peter Mcguire, who's joining us this morning. Always a pleasure, Peter. How are you today?
Oh, very well, thank you, Abha. Very, very well.
Looking forward to the weekend, I hope. So,
yes, absolutely. Beautiful weather in Sydney.
So jealous. All right. Well, Peter, this morning, of course, we're seeing a bit of a cool-off in global equities. We've got a couple of those central bankers maintaining a hold, and now NASDAQ as well as Asia all under a little bit of pressure. Momentary, you think?
Well, I think so. Look, we've had a lovely run up, and I feel as though that we've just had a little bit of a breather. There's the interesting news that came out last week. It was quite a week, of course, with that public holiday in the United States as far as trading on Monday, and it's been a fairly non-eventful. I think that the markets will probably come back to life over the next couple of weeks. But yes, at the present time, there seems to be a lot of the hot steam has come out of it, and it's just having a little bit of a breather.
Mm-hmm. Good morning, Peter. Of course, Indian markets seem to be on a momentum of their own. And sometimes a lot of commentators would say, the valuations don't match what the market's doing. But, from experience, Peter, the markets rarely have anything to do with valuations beyond a certain point. They get into the realm of hopes and dreams. So could this hopes and dreams take the Indian market another 40-50%? Of course, we know how all this ends. But, hey, if you're having a great night out, what's the big deal?
Well, exactly, Ashu. Well, I don't know what the uptick's going to be over the short run, but I think the long run, in the years ahead, I think when you look back, I think the market's relatively cheap. So I think the Indian market will have a lovely uptick for the next number of years. The IMF numbers and the growth numbers, you can't challenge them. And fundamentally, it's a growth story that's going to increase as the years roll on, versus a lot of the other markets, I think, are fully priced. If you look at Europe, of course, and probably Japan, it's the way the smart money needs to be, and I'm sure the subcontinent's going to attract far more.
Right. Fair enough. Peter, in the current environment then, what's the kind of fund flow action you anticipate into emerging markets, particularly India? Are investors now looking at other emerging markets that are starting to look a little attractive as well, given that we're trading at fairly high valuations, or do you still see a lot of strength and momentum here?
Well, if I look, I look at the Vietnam market, and some of that Southeast Asia is quite hot, and they've had, I think they've got good growth trajectory in the short to medium term. I think 17 and 18 will be good years for a number of those markets. But I fundamentally think that, the Indian market will capture far more interest because I think there's further upside than a lot of these other markets. It's just got more potential, and you've got so many wonderful factors lead into that, not only from a technology, but also from innovation, mathematics, and of course population base, which is young and very, very entrepreneurially spirited. So I think that's going to be, as the globalised world becomes more the normal way to do things and more competing forces, I think it's going to greatly affect a lot of the large players, and small, nimble disruptors will certainly capture market share.
Peter, one of the ways I've been trying to read into a boom in commodities is to see what Australian companies are doing, because a lot of Australian companies are actually the first movers into Africa, do the first JORCs, what have you. But I've not seen many Australian smaller and mid-cap mining companies really doing much as they were, let's say, 6, 7, 8 years ago. To me, it seems like the commodity cycle is really not starting out. Maybe the Shanghai Futures Exchange gets excited from time to time, but I don't see that happening on the ground level.
Yeah, I think you're right. When you look at it, the large sell-off and, of course, meltdown as far as oil prices, iron ore, have a look, as far as the copper, nickel, lead, zinc, aluminium, tin, all of those have hemorrhaged. And couple that across as far as energy, probably put some sort of context. I was looking at some numbers the other day. 2013 global spend for for oil and gas exploration was about 220 billion US dollars for the year 2013. 2017 it'll be about 140 billion. So it's a shrinking capex spend, and where companies are trying to maintain profitability, of course, is by slashing headcount, as we've mentioned over the last 6 to 12 months together. So, that seems to be the common raison d'etre as far as business. And at the present time, I think it'll probably remain. So it's going to greatly impact, as you said, the smaller, mid-caps, explorers and so on. There's just too much risk and not enough upside.
Peter, with interest rates at zero or close to zero or maybe even negative, I was a little taken aback when I read about the South Korean company Hanjin, basically declare bankruptcy and leave 14 billion worth of goods on sea. I mean, I believe some 100, 200 ships are just drifting around the world, not knowing where to go because they don't have the money to even pay the ports to offload these products. What's going on, Peter? Are we now seeing the real economy in serious trouble? And I know a lot of the Japanese trading houses are in serious trouble. So is, let's say, houses like Glencore, where they got billions of dollars of losses. But of course, the central banks make us believe like nothing's happening around the world. Could we see a real collapse in the economy because a lot of these trading houses are in deep trouble?
Of course, exactly right. I mean, the shipping industry, we've had an overabundance as far as the shipping construction, 9, 10, 11, 12 were very, very strong years, 13. And now, as you said, there's excess capacity. And there seems to be, and this is the challenge for every industry, but primarily when you're looking at, transportation and Baltic Dry Freight Index and so on, the shipping is a wonderful barometer to give us a very clear understanding as far as what's going on as far as movement of goods across the planet. And when you've got, large players, as you mentioned, out of South Korea that are trading hubs, and they've got ships that have got nowhere to call home and they can't pay their bills, then you're going to see far greater bankruptcies. And I think that, this is the challenge that all central bankers face. They've tried every lever and every trick under the sun to try and get growth, and no one can get growth. And that's the challenge ahead. I mean, you see numbers, 5,000-year interest rate lows. I mean, that's a hell of a long time.
Okay. Peter, when it comes to next week now, as we head into a fresh week, what's going to be top of mind for you? Status quo.
US base, yeah, well, I don't know. I mean, I look at where it's going at the moment. I think there's a groundswell against Clinton, and it's building, and it seems to be very interesting, the numbers that Trump's capturing. And I think that this will gain more momentum as each week goes on, but I think it's just, you can more or less taste it. I can feel it. You can just see it as far as the media is concerned. Trump seems to be more on the front foot, and Clinton's in a little bit of a defensive mode. So that's going to be interesting how that plays to US and, of course, Eurozone. And I'm seeing what goes on as far as we've got a meeting in the next couple of weeks in Algeria as far as crude. It seems to be oscillating around that 47, 48, 44 sort of number. Gold's interesting, and I think there's going to be more volatility as far as US dollar. So I think it could be a very interesting, 3 to 4 weeks ahead of us.
Peter, I'm going to just ask some questions. In a bull market, as you know, especially in Asia, it's very difficult to ask difficult questions because generally, xenophobia builds up. Oh, well, everything is fine. No, nothing is wrong with any place. But I need to ask you some brass tacks questions. If India is doing so well, I'm just wondering why mergers and acquisitions activity into India has not increased. when the Chinese were doing well, they were buying trillions of dollars worth of stuff in Australia. They were buying stuff in US. They were buying stuff in UK. They're still buying. Maybe they're not buying at that pace, but they're still buying. Two, the rating agencies don't think we are any higher than Azerbaijan or Latvia. And they think the Chinese are AA3, which is basically the same as UK. So could you share with me, Peter, looks like the stock markets usually are very enthusiastic, but I got to look at all the data around. And oil imports into India fell 28%. So, I mean, the economic data that I see and the sales pitch that I see don't really seem to jive.
Yeah, I mean, well, is there a global slowdown? And when you look at shipping, and you look at, and we just discussed that as far as South Korea, and you're saying as far as crude imports and energy imports, is the world slowly grinding, even at its growth patterns that we experienced over the last 10 to 15 years? We're not able to get those sort of headline numbers any further. There are some emerging markets, and markets like India, that are still doing relatively well. But you look at the Eurozone, and it's flatlined. There's no growth. This is I think, one of the great challenges and the great problems ahead. How do you stimulate? And this is where central bankers are, rolling up their sleeves and going, well, what's the next trick we've got to try and create to get some growth? We've given the money away. We've printed more than you can jump over, and that still hasn't ignited and had, benefits across the board. You've got sovereign wealth hemorrhaging. You've got disruptors coming in and new technologies changing those, existing landscapes. It's a very difficult time, and globalisation, as much as we like it, there are some proponents of it that look at it and go, it's been, diabolical for certain countries.
Peter,
it's a very difficult question to answer.
So I also want to ask you, sometimes, central banks are deciding interest rates on labor markets. And Peter, you've been around. At one time, our parents used to work in businesses that required, hard labor. They used to work in mines. They were working in factories that produce real products. Now, essentially, I make coffee, sell it to you. You make muffins, sell it to me. Abha makes biscuits, sells it to me. We seem to be just running a biscuit and coffee economy, and that's where the jobs seem to be coming from. How can we expect any real growth if you're doing this basic work, and that's what most of the employment seems to be coming from?
Well, when you look at that, and that's exactly right. I mean, when you think of Australia and new cafes opening up and coffee houses and so on, manufacturing's gone. We don't make anything over here anymore. We can't compete on a global stage. And that's you've got those large manufacturing hubs, be it China and certainly parts of Asia and India. And you've got look at the steel mills of, going back to the 60s and 70s, the Bethlehem steels out of the US, titans of industry for 100 years and end up bankrupt. Kodak, the same. The Dow Jones is littered with failures that lasted, they were titans of industry for 70, 80, 90 years, and they just imploded through new innovation coming through or changing the way that we do it. And that is just a totally different subject. And I think that, you're right. Offering different services to each other, it's very much a service-based industry. And the services, I mean, I had a very interesting talk yesterday with one of the top professors at the University of New South Wales, and he was saying, well, what's happening with education is changing. People don't need education. You go onto Google and you seem to be an expert in anything.